Microsoft stock just jumped 25% in a single week. Many investors think they've missed the opportunity, but that couldn't be further from the truth. Today I'm going to show you the fundamentals and I'll reveal the exact price I'm willing to pay for Microsoft stock towards the end. Let's dive straight into Microsoft's fundamentals, starting with revenue. Microsoft's revenue reached $90 billion this quarter, up 17% year over year, and Microsoft's revenue growth rate is actually accelerating, not slowing down. At the scale of a company like Microsoft, you'd expect revenue to slow down over time due to the law of large numbers, but clearly that doesn't apply here. But where's all of this growth actually coming from? Well, Microsoft is the second largest cloud computing company behind Amazon. The cloud computing market is expected to grow at a rate of 15 to 20% over the next 10 years, and Microsoft's own cloud computing division grew revenue by 32% year over year to $39.3 billion, with Azure, which is Microsoft's enterprise cloud, growing 43% year over year. And the company says that demand for Azure continues to exceed the available capacity. And to visually understand the size of that demand, we can look at this chart which shows the value of Microsoft's cloud backlog, or RPO. This is basically contractually agreed revenue that will be recognized in the future once the service has been delivered to the customer. In this recent quarter, Microsoft's cloud backlog reached $678 billion. That's growth of 127% year over year. Even on a 5-year average, the cloud backlog has grown 42% annually. That shows just how in demand cloud services are right now. And Microsoft said that 30% of this cloud backlog is expected to be recognized as revenue within the next 12 months. That's over $200 billion of additional revenue. But cloud isn't the only part of the business that's growing. Microsoft's consumer subscription service 365, which includes software products like Word, Excel, and PowerPoint, grew revenue by 24%. This growth was mostly down to Microsoft raising the price of its bundle. But even without the price increases, 365 saw subscriptions grow by 7%. Microsoft no longer publishes the exact subscriber numbers. In 2025, they reported 89 million 365 consumer subscribers, so we can assume that number is somewhere around 95 million today. So what does all this growth mean for Microsoft's operating margin? Well, despite massive spending to build data centers for their cloud computing business, Microsoft's operating margin remains at a healthy 45%, which is actually slightly higher than this time last year. Microsoft doesn't report its operating margin for their cloud computing business, but we can infer that it's similar to Amazon, who are the market leader. Amazon Web Services operating margin is just under 40%, and it's only increased over time as demand has grown and the product has become more valuable. Alphabet, which is the third largest cloud computing provider, reached an operating margin for their cloud division of over 35% last quarter. So I think it's reasonable to assume that Microsoft Azure's operating margin is somewhere between 35 to 40%. But with all that being said, how much is Microsoft actually spending to build these AI data centers to fuel the growth of their cloud computing business? Here you can see that in the last 12 months alone, Microsoft spent over $115 billion on capital expenditures, more commonly known as CapEx. This has been one of the big themes in the stock market over the last few years. All of the massive tech companies are investing hundreds of billions of dollars into artificial intelligence related computing power. The question that investors are asking is, when is the spending growth going to slow down? Because right now it looks completely unsustainable, and the return on investment has also been questioned. However, the evidence, mainly Amazon and Alphabet's 35% plus cloud operating margins, suggests that these AI investments are actually worth the risk. But what is it about Microsoft that allows them to maintain such a dominant competitive position? Microsoft's most important competitive advantage is their distribution moat. Over the decades, Microsoft have built a huge customer base, and I'm not just talking about consumers. There are millions of businesses, including large enterprises, that are entirely dependent on Microsoft. They've basically become a business utility, and that creates switching costs. With millions of business customers who have built their entire workflow using Microsoft software and their cloud services, it becomes incredibly difficult to switch to one of Microsoft's competitors. If all of your employees use Microsoft on a daily basis and all of your data is stored in Microsoft's cloud, there's no incentive to switch, even if a competitor can offer the same capability for less money. And that's exactly what gives Microsoft one of the greatest competitive advantages that a business could ever wish for: pricing power. Pricing power is the ability to raise prices at above the rate of inflation without losing customers. Those extra profits can then be reinvested, developing new products or services to expand the business even further. An example of this in Microsoft's case is using using the profits generated by their consumer and enterprise subscriptions to expand their cloud computing business. This allows Microsoft to be self-sufficient and avoid taking on debt, although that's changed in recent years as the company scaled up its cloud infrastructure investment. But once the build-out is complete, Microsoft's balance sheet should become a fortress once again. But what about Microsoft's valuation? The company currently trades at a 25 PE ratio, which isn't actually that expensive. If anything, for a company with the quality of Microsoft, a 25 forward PE ratio could suggest that the stock is undervalued right now. In the past 5 years, Microsoft stock has rarely traded below a 25 PE. A 30 PE ratio is essentially the baseline for the company stock. I would usually look at the company's free cash flow yield when assessing its valuation, but with Microsoft's current AI investment cycle, free cash flow has become lumpy and unpredictable. That's why I think the price to earnings ratio is a much better indicator. But what if we compare Microsoft's valuation against its peers? Here you can see Microsoft in green, Alphabet in red, Amazon in orange, and Meta in blue. I've used price to operating cash flow as the valuation metric because it isn't distorted by the huge AI investments these four companies are currently making. As you can see, Alphabet is clearly the most expensive of the four, trading at 24 times operating cash flow. And Meta is clearly the cheapest, trading at 11 times operating cash flow. The other two, Microsoft and Amazon, are in the middle of the pack, trading at 20 and 18 times operating cash flow respectively. So with that being said, I'm going to show you my base, bear and bull case assumptions for Microsoft stock over the next 5 years. In my base case, I'm assuming earnings per share growth of 20% and a 30 price to earnings ratio. In this scenario, Microsoft stock would increase from $500 to $1,340 per share over the next 5 years, providing a 22% annual return, much higher than the market average, suggesting that Microsoft stock is undervalued right now. But in my bear case, I'm assuming 15% earnings per share growth and a 25 price to earnings ratio. In this scenario, Microsoft would increase from $500 to just over $900 per share over the next 5 years, producing a 12.5% annual return. Not bad, but only slightly higher than the market average, suggesting that Microsoft stock is probably fairly valued right now. But what if we add some pretty bullish assumptions? In my bull case, I'm assuming 25% earnings per share growth and a 35 price to earnings ratio. In this scenario, Microsoft stock would increase from $500 to over $1,900 per share in the next 5 years. That's a 31% annual return, or almost 4x upside from today. Way better returns than the market average, suggesting that Microsoft stock is deeply undervalued today. As suggested in the title, I added to my Microsoft position after their earnings report, increasing it from a 9.5% weighting up to 10%. I made a few adjustments in other areas of the portfolio to add to Microsoft, but I'll reveal those changes in a future video. I think Microsoft stock is undervalued at today's price and likely a good deal if you can get it for less than $700 per share.